We'll wait just a moment as people are entering the room. All right, well, appreciate your patience as we had a few technical difficulties, but my name is Michael Rivera. I'm the CEO of the Association for Corporate Growth Los Angeles. Welcome to our most recent event, our healthcare panel, coming up for air, healthcare investing and growth in 2021 and beyond. I want to thank Adam Abramowitz from Intrepid Investment Bankers and Eitan Dahuki from Shepherd Mullen for helping put the panel together today. And also recognize Intrepid Investment Bankers as our sponsor for today's presentation. Adam, let's kick things off, please.
Sure. Michael, great to be here, and thanks everybody for joining here today. I think we've assembled a panel of some pretty top-notch investors and executives here to share some thoughts around where we are in healthcare services investing, what's happened over the past year, how are companies dealing with COVID-19, especially from an M&A perspective and capital raising perspective, and now with hopefully more and more vaccines rolling out, where do we go from here? What does life look like? Maybe we'll just do some quick introductions here, and I think we're waiting on one more panelist to join here, but in the interest of time, wanted to get started. Very quickly, my name is Adam Abramowitz. I'm a partner with Intrepid Investment Bankers here in Los Angeles. We help companies raise capital or think about going through M&A transactions. My partners and I started the firm in 2010, and now we're a part of MUFG Union Bank. And together with my colleague, Jonathan Bluth, lead our healthcare and life sciences practice. And I'm thrilled to be hosting this panel today with my good friend and colleague that I work quite a bit with, Eitan Dahuki, for the Shepherd Mullen. Eitan, would you like to introduce yourself?
Sure. Hi, everyone. I'm Eitan Dahuki. I'm private equity team leader at Shepherd Mullen, and I am an M&A and private equity attorney. Spend most of my time in the healthcare services space, and so working with a lot of the people that are going to be talking on this panel. And again, before we get started and introduce our panelists, just a reminder to everybody on this presentation, we're going to be talking about things that are germane to the healthcare services sector, and there might be some words that are thrown around that you may or may not have heard, and we think these things are all very key, important words that deal with the healthcare industry. You'll hear things like value-based reimbursement. We'll be talking about technology. We'll be talking about different types of care and service provision that have been working for healthcare providers. If you have any questions, please feel free to leave us a question in the Q&A, and we'll try and address those either during the flow of the conversation or towards the end here. And so let's let the two of our three panelists that have been able to get in here introduce themselves, and then we'll jump into some questions. John, do you want to take a minute to introduce yourself first?
Sure. Thanks, Eitan. I'm John DiGiovanni. I'm an investment partner at Arsenal Capital Partners. We're a New York-based private equity firm, and we're investing out of our fifth fund. We were founded in 2000, so we've been around for a couple decades, and we invest across specialty industrials is about half of what we do, and then healthcare is the other half, which is where I focus. And within healthcare, we focus on investing in pharma services, healthcare IT, and then specialty care providers, where I spend a lot of my time. And our current fund size is $2.4 billion. We're in the process of looking ahead towards our next fund, which we expect to raise later this year. And yeah, I would just say we a couple of distinguishing factors. We take a very thematic approach to investing. So we spend a significant amount of time working with our advisors and expert network to help to build out our investment themes, some of which I think we'll talk about today. And then we have full-time operating partners on staff. So unlike myself, people who have really scaled and run healthcare businesses working with us full-time and really help us to drive strategic growth with our portfolio companies, which we're really proud of. So thank you guys for inviting me. Happy to be here today.
Great. And I can see that we just added Shane Armstrong in. So not to let him wait, why don't we just let Shane introduce himself? Shane, sorry that you had a little bit of trouble here, but we're just
no, you think I figured out by now.
Could you tell us a little bit about yourself and your organization?
Sure. So Shane Armstrong, the president and general counsel at American Vision Partners based out of Phoenix, Arizona. We're a Southwest-based ophthalmology practice that focuses on comprehensive eye care with specific emphasis on outpatient surgical care. I've been with the practice since its inception. That it was created through an affiliation with private equity sponsor, and we've essentially begun to combine various ophthalmology practices from around the Southwest. One of the original partners was Southwestern Eye Center, of which I was the CEO prior to the formation of American Vision Partners. So I've been in the space now for a few years, and appreciate being on the panel.
Awesome.
Great.
Rob, what about you? I think you're on mute at the moment.
Yeah, Rob Mahan, I'm CEO for Exer Urgent Care, and I've been with the company for about 4.5 years. Exer Urgent Care is really sort of focused on being kind of an ER alternative. So we are staffed with ER doctors and given a broader range of diagnostic equipment. And really our approach is to provide a couple of solutions. One is providing access to episodic or immediate care. So in other words, physician practices oftentimes are pretty inundated and it's hard for them to get care, immediately. And so we provide a solution. And then the other side is it being staffed with ER doctors and having this, kind of additional tools at their disposal. We think we can see about 80% of the patients that are being seen in the ER today. So it helps to kind of decompress our hospitals and our ERs, which have been particularly hard hit over the last year. And besides that, we have 4 sites. We had 4 sites when I joined. We just opened yesterday our 20th site. So kind of growing, and we're really focused in the LA County market and a little bit in Ventura today, and probably heading into Orange County at some point in the not so distant future. So that's us. That's me. Thanks for having me.
Congratulations. That puts you guys up there in terms of scale for urgent care branded operations. Well, let's do this just to get started, right? What the title of this panel was about coming up for air and just thinking about ways that COVID has impacted different businesses in the healthcare sector and how they've responded. And I would like each of Shane and Rob maybe just to give you each some time to give us maybe a high level experience that your organizations have had over the last year, and maybe how they responded to the pandemic. And what I'm curious about is, what's the biggest change between where you were a year ago and where you are today? Maybe we can start with Rob.
Yeah, so 2020 was a heck of a roller coaster ride. So, I think from the time that it hit and, oh my gosh, things are really slow. And then all of a sudden, oh my gosh, things are incredibly busy. And then they got busier. And, I think we doubled in census from April to May, and then from May to July, we doubled again. And then from July to November, doubled again. And then of course, now that we're on the tail end of COVID, things are starting to, come back down. So I think what it really forced us to do was a couple of things. One's just purely the logistics side of things, which is how do you make sure that you keep your staff and keep the patients that are coming to the center safe? So things like adding in screeners at the front before people can come in, sort of really going through really refining our marketing a little bit, because we had to sort of focus in on making sure that our folks that were coming to Exer felt safe. And then I think the other thing that was really sort of, it was a healthy sort of force, but sort of forced upon us, was to really start to rethink our processes, because our processes that worked really well at one level of census or average daily visits, we use the term either ADC or average daily census for that. Just so if I catch myself if I'm busting out some lingo. And so, processes that worked really well at those lower volumes just simply got strained as we expanded in volumes. And so it forced us to innovate. And that was everything from starting with creating a call center where we went from 1,600 calls a day to 10,000 calls a day, and simply overwhelming our existing processes and systems. We also launched a virtual care, so that we had a system where people didn't have to come into our facilities in order to receive their care. Later on in the process, everything's a little harder in healthcare. So, the basic thing where, you go to a restaurant and you get into a virtual line and, they text you when it's time for your table, really, really basic. But in healthcare, you got to make sure it's all HIPAA compliant, and for some reason that just seems to be 10 times more complicated, even though it doesn't seem like it should be. So it took us a while to get there, but we were able to create virtual queuing. So especially when we had longer lines, letting people kind of get into a queue from their home, and then sort of texting them to let them know, hey, it's getting closer, it's time for you to come to the facility, et cetera. So nothing that seems, I don't think, doesn't sound overly transformative in the broader world and what restaurants have been doing for years, but for us was a big step. We also created a patient portal that allowed people to log in and get the results. And eventually, again, fighting through HIPAA compliance stuff, was able to get to a point where, at least for COVID tests, we could text negative test results directly to the patients, along with the ability to kind of print those results if they needed them. So I think probably for us, maybe the biggest piece was really challenging our logistical processes, and then also really forcing us to kind of innovate a little bit technologically, which probably should have been doing anyway. And I think it just sort of forced our hand a little bit, but I think in a healthy way.
Awesome.
Really
Thanks, Rob. What about you,
and how about you, Shane, from the ophthalmology perspective?
Yeah, I think, Rob did a great job of kind of streamlining comments, because you could probably talk all day about that. I could as well. Pretty involved across the board. I think, when we all got hit in the mouth with this about mid-March of last year, nobody really knew what to do. I mean, people, maybe in hindsight like to talk about some of the specifics that, oh yeah, this, did well. But like Rob, we were just kind of learning on the fly some things that maybe we should have been doing, but we're kind of forced to do once we got into that position. We were a little bit unique in the ophthalmology space, particularly given that we're comprehensive eye care, because as many will recall, initially out of the gates, at least on the healthcare side, you had to focus on emergent care to kind of preserve the PPE. In ophthalmology, a lot of what we do could be deemed as elective, but we quickly learned that that's a fluid concept, right? The things that are, objectively emergent for us was what we focused on, in that kind of tail end of March, which for us is retina care and glaucoma, things that if patients didn't get that care, they would lose their sight within a matter of days or weeks. So we focused on that. We actually had to close down about 80% of our operations, furlough nearly 1,000 people, and kind of went into this very strange mode of, what's emergent versus what's elective. And we were in that mode for about 6 weeks, where we were really just trying to get a handle on who we could see and who we really couldn't see. And like Rob, we were really focused on gathering the PPE that we needed to ensure that our staff was safe. And to do that, within our organization, we have what's called a medical executive committee headed up by our CMO, and different representatives from our subspecialists across our platform. We're in Arizona, New Mexico, Texas, Nevada, have about 100+ locations, and through this kind of representation of these various doctors, we're able to align on what we thought were clinical best practices. And after about kind of 6 to 8 weeks, we recognized that what was elective in mid-March wasn't elective, heading into kind of late May. And so we were able to thread the needle and start to get more and more patients in, so that by the time we hit June, we really were able to focus on what we consider to be really more cosmetic type procedures as our elective procedures, like refractive, LASIK, that sort of thing, versus some of the things that had become more emergent for our patients that were affecting their quality of life, impacting how they drove, for instance. And these were elderly patients too. So like Rob, we had to do some things like virtual queuing, had patients, wait in their cars, had to kind of get around some of those HIPAA challenges associated with getting them to wait in their cars and then come in when the time was right, making sure that we were social distancing, having screeners at the front, checking temperatures. We went so far as to implement safeguards where, we asked patients to use our masks, because we found that so many patients were coming in with ill-fitting or soiled masks that didn't really do the job. And so a lot of different kind of nuances that I'm sure, Rob and others experienced like we did. And so we learned a lot on the fly, had to move quickly. But then at the end of the day, you still have a business to protect. doctors' salaries, staff salaries. You need to get people working as soon as you can, and ultimately you've got patients that can't see, for instance, without that care. So it was a difficult balance to strike early on. But like Rob, we found that once we got into kind of that June time frame, we started to see some real high level demands that we had to meet, but meet safely. And so it was a difficult balance, like I said, to strike. And we're now to a point where we're starting to get back to some level of normalcy, albeit with masks and still more safety protocols. But we've learned a lot, and I think are much more efficient, as Rob said, in our operations as a result.
Really interesting. Thank you, Shane. Rob, John, I'm curious for your perspectives from the private equity standpoint. And you're an investor in Hope Bridge, which is one of the largest autism services platforms in the country. And I understand that business has continued to grow and expand during COVID. How did Hope Bridge respond to COVID, and what M&A opportunities did you see for the business in the past year?
Yeah, it was a challenge. So I would echo a lot of what Rob and Shane mentioned. So Hope Bridge provides ABA therapy, which is applied behavioral analysis for autistic children. So autism spectrum disorder, neurodevelopmental disorder that impacts really every aspect of the children's life. And Hope Bridge has been providing ABA therapy now for years, and is one of the largest providers in the market. And it was tough. Hope Bridge is a national center-based business, so we serve thousands of kids, young children, and we had to shut down centers for a period of time in the March-April timeframe last year. And we pivoted, so we adopted virtual care tools. We did have to furlough, a significant percentage of our junior staff, but Arsenal invested into Hope Bridge just to maintain our senior staff. So we have a couple hundred BCBA senior ABA therapists, and we held on to those therapists, which I think really paid dividends for the business in the long term as we rebounded, and autism was deemed an essential medical service a few weeks after COVID really hit hard. We were able to hold on to our senior clinicians, bring back our junior clinicians pretty effectively, and establish some loyalty within the staff. We did adopt some telehealth and some virtual care. We adopted some home therapy, so we kind of diversified our care settings beyond just the centers, and that was pretty effective. And telehealth was a nice alternative to help with things like parent training and supplement care. Don't view it in this particular subvertical as a long-term alternative for us to just the in-person care and the importance of the physical care. But we definitely broadened our toolkit within the business. And I would just say that COVID was really validating for the market as a whole. So our business and our CEO, Dennis May, executed really effectively, and they network with other big providers in the market. And I think a lot of businesses, they did really well to rebound because parents were very concerned about regression to maladaptive behavior for their children, and advocacy groups were very supportive and intent on the care being opened up and provided again as quickly as possible. And you saw that happen, and I think it'll be ultimately really good for the market in the long term.
Let's transition back and talk a little bit about what we're going to be doing coming out of COVID. And Shane, I know you're in Arizona. I saw today that the governor has essentially decided to throw a big party with a piñata and take off all restrictions and no masks and nothing. So, it sounds like, at least in some parts of the country, it's no holds barred, let's go, right? And when you look back at where you were before this, American Vision Partners was growing pretty significantly through acquisition and just organic growth. And I know that you went through this very rocky road where you had to shed a significant part of your administrative staff. You've rebuilt. you're retooling. Tell us about how you're looking at the outlook for M&A in the healthcare sector, for growth, and ultimately what you see going forward in terms of volumes and how, you know, you're potentially going to be leaving COVID in the dust, especially in a state like Arizona that is not quite as restrictive as California right now.
Yeah, no, good question. You know, it's an interesting dynamic. When COVID first hit, you know, and we were kind of forced to shut down a good portion of our operations. Obviously, there's, you know, kind of central administrative support in different functions that apply to that. And for us, business development was one of those things when we started to think about M&A, we're like, well, we're not going to get any deals done in the foreseeable future, right? This just does not seem like a really kind of a crucial department for us right now. Nobody knew where it was going to go, how long it was going to last, what it meant. And so any kind of deal making that we were doing or thinking about in March, you know, we just essentially put on the back burner and really transitioned away from. It was interesting because about the time that we started to really see the volumes picking back up, you know, I'd say really in kind of June, July timeframe, we started to get a lot of inbound interest on, you know, from different, you know, providers that were looking at potentially selling. You know, maybe they just got kind of overwhelmed by what they needed to do from a COVID perspective, what that meant for them, you know, and we started to get all this interest. And so it started to make us think a lot differently about, well, okay, maybe we do need to pivot more quickly than we thought. And that just escalated with each month, right? And we started to recognize that more and more that this, we were going to get back to a sense of kind of normalcy as it relates to M&A much more quickly in some respects than we would in other areas. And Arizona, you're right. There have always been restrictions here, but they haven't been as intense as they are in states like California. We do have operations in California. And so we were seeing kind of the differences between Arizona, California, Nevada, New Mexico, Texas, all these places that we have operations and kind of engagements. And we were seeing, you know, what we're doing over here may not apply to what we're doing over here. Arizona, for instance, as it relates to kind of the dissemination of the vaccine has been really ahead of the curve. And in fact, they've opened it up to all folks in the state above the age of 16. And so, you know, the governor here is saying, well, you know, we've got this availability for the vaccine. We've got over 1 million people that have gotten both doses of the vaccine, so we can lighten some of these restrictions. You know, for us, as I mentioned early on, we were really following the guidance of our medical executive committee, but we also created what we call the COVID task force, which was made up of doctor leaders, but also administrators who were focused on putting policies and procedures in place that would keep patients safe, but would also, and staff, but would also give us the opportunity to run our business with some peace of mind as we started to see this volume rebound. And we didn't want to leave these patients in the lurch that needed us for their eye care. So we were meeting daily to go through, and it was a moving target, right? The CDC was coming out with recommendations daily, and it was like, does anybody really know what's going on? And it was pretty clear that really, as much as the experts wanted to say they knew, nobody knew, right? And so we recognized that in a lot of ways, we were just kind of on our own. We had directives from the states where we operate that we had to abide by, but there was a lot of gray area. And so we leaned on our doctors during that time to tell us what is best for the patients, what is truly best for the patients and for our staff. And that's how we kind of managed the business and were able to still, despite all of that, meet our budget for 2020, which was shocking to us. But as Rob mentioned, we did see some things rebound quickly, and we were quickly then rebuilding our M&A team and have now expanded that team to almost 3 times the size of what it was prior to COVID, because there is so much interest in doing these deals. But, you know, as you guys can appreciate, valuations haven't dropped with the kind of influx of COVID and the risk associated with it. So to your point, Eitan, we find ourselves in a situation where even though national and local governments may be taking more aggressive action to loosen, we do that, but we do that, I think, with much more caution, I would say, than maybe some of the local governments are, because we don't want to find ourselves in a situation where we get too loose and then we have to kind of reinvent the wheel again if things pick up. So we try to be cautious in that process.
Yeah, you really, to talk about your perspectives about the world opening back up, Shane, to play more on that theme. As the world opens back up, Rob, I'm curious for your perspectives. It seems like a lot of consumers and patients were really introduced to the urgent care model in the past 12 months, or maybe they didn't experience it before. Can you talk about how Exer's trying to capitalize on maybe the new introductions to Exer and what you're trying to capture those patients for the future and show them the value of your model?
Yeah, so I think, maybe two sides to that coin. First, it's just more sort of the same store growth component of that question. And so I think there, because a lot of the volume that we had, I commented earlier, we had a lot of it dipped and then we had a lot of growth. That growth I probably should comment on was a lot of that was COVID testing, so sort of really skyrocketed with COVID testing, which was wonderful in the sense that we had a very high percentage of people coming to us that were new patients, people that had never been to Exer before. So we're introducing them to the brand. And basically we found that there's nothing that sells the brand better than having people come in and sort of kick the tires, experience it. And so I think really sort of making sure that we try to sort of say, look, there's got to be long-term benefit from these people, because typically we see people return. Maybe they're not as sticky as the people we've seen in the past, but there's certainly be some component that come back. So what we would continue to message over and over again to our providers and to our staff, because they were tired while this process is going on, was, look, just remember, this is their introduction to this brand. This is the introduction to who we are. Give them that amazing experience. And so that combined with also, again, some of those tools we talked about. And it was tricky because not only were we seeing some of these patients inside our facilities, but many of them we were seeing in their cars. And how do you provide the same level of care, but provide it to them, in their car? And then, of course, in certain situations, you have somebody who's sick, and how do you sort of safely bring them into the center, into a very special room that's HEPA filters and all this other stuff, and they got to go through a special door and, et cetera. So a lot of kind of this balancing of safety combined with making sure we give everyone a wonderful experience as they're sort of going through it. And I think the other part of it too is we were lucky in the sense that we brought on a new marketing resource right before COVID hit. And so it gave us the opportunity to really go in and clean up a lot of our marketing, do a better job in terms of kind of our email campaigns, trying to sort of build that connection. And it just so happened our resource, I'm terrible at social media, but she's great at social media. So she was able to really go in there and say, your guys' social media is terrible. And I said, I totally agree, but have no idea how to fix that. So she came in and really got that going, which again is a way to kind of promote that community. And I think from that perspective, hopefully sort of improve that kind of stickiness, combined with some of these innovations that they get to experience. So I'd say that was kind of the same sort of growth side of it. On the other side, more of kind of just expansion and growth. So a little bit of what Shane was talking about. On our side, we actually found a lot of opportunity because of COVID. So, a lot of times when we go in, we talk, we take a look at spaces, and we knew very clearly what the demographic was for what we were looking for in terms of our space. But then when you're trying to get the actual sites, that can be a challenge, especially in LA County. You've got these areas like Sunset Boulevard and Hollywood and, whatever, where the landlords would look at you and they'd be like, we don't really want a lot of sick people walking around here. We feel like that's really going to sort of detract from the brand, so thank you, but no thank you. And, once COVID hit, all of a sudden it was, and all these restaurants had gone out of business or had started to sort of right-size themselves. It was all of a sudden we were getting a deck presented to us, superimposed with us in a space, like, can you picture yourself here? So it was a real change for us from that perspective. And so it allowed us to take advantage, I think, of that opportunity. So we have, now we haven't done a lot of acquisitions. It's not been our sort of core focus. We've been much more organic growth oriented. And so we have we've never had a pipeline like what we have right now in terms of additional sites. And these are sites where we just never would have been considered for them before. And so from our perspective, I think that's the other side of that question in terms of trying to, how do we sort of take advantage of this time and try to promote our brand with the general population. So hopefully that'll, knock on wood, allow us to open more sites and have the same response with those that we've had historically.
Rob, I'd like to just follow up on that. And John, I actually would like your perspective on this as well afterwards. Urgent care, we can look at the same thing in behavioral health. These are two sectors of healthcare that are incredibly active in the M&A space because they're so fragmented. In particular, both of those two segments, ABA is a lot of onesie, twosie providers, BCBAs that are providing services out of their house. And with urgent care, you have, just literally all over the country, one site that's operated by, Doctor Who. And so those are both in these sectors that are incredibly ripe for consolidation. And I know, Rob, you mentioned that you focused more on organic than inorganic growth. And I'm just curious to hear about maybe some reasons behind that and whether you are thinking about reevaluating that in terms of your expansions outside of Los Angeles. And then maybe we can let John comment a little bit about his view on expansion, particularly within the autism business or otherwise.
Yeah, it's a great question. I think my investor group asks me that question all the time. So the reason why we've done more de novos is we actually at one point were very focused and thought it was going to be a great opportunity acquisitions. But what we found was, again, that classic thing, related to retail healthcare is that people talk about retail healthcare, but so much of healthcare is still just healthcare that's tried to call themselves retail. And so the classic real estate lesson, location, location, location. And so a lot of times we go in and we would look at a space. Our footprint's a little bit different than maybe your average urgent care space, a little bit bigger. And definitely we want to be right there in that premier spot. We believe that that's an important part of the strategy. So you could go and you could acquire a unit, but it's going to be capped out in terms of its census, both in terms of the physical space, but also I think in terms of what they could potentially attract given the location that they put that in. And it always puts you at risk that somebody goes in and drops one in the right spot, and all of a sudden that facility you bought is all of a sudden, dropping and you kind of caught a falling dagger. So I think from our perspective, it wasn't that we're against acquisitions. And in fact, I think we would continue to describe ourselves as being opportunistic. We just haven't found a lot of opportunity in that space. And again, a lot of the urgent care space, I think, is pretty unsophisticated and probably much less sophisticated than optometry and probably even less than autism, although, probably that's not a particularly sophisticated space yet, but I think it's probably moving that direction. So I think that reflects in what you're looking at to acquire. And then I think the other part of it is that people talk about urgent care as all being one thing, but there really are two big there's a big division in urgent care between kind of folks very focused on workers' comp and ACMED and, sort of almost like, can we get the patient and can we keep the patient? And, am I really motivated to get that patient back to work? Or am I really motivated to kind of keep that patient, here kind of going through the treatment? We've been much more focused on kind of the ER alternative and much more kind of episodic. And so again, their clientele doesn't necessarily align with, I think, where our core competencies lie. So as a result, we get excited, we look at it, and eventually be like, no, this doesn't fit with us. And so we did that dance a little bit. Then we decided there wasn't as many opportunities. There's probably one or two kind of really interesting opportunities for sure. But overall, it's not something where I think we would just go in and start gobbling up onesies, twosies, and trying to bring them into our space, at least today. Who knows what the future holds?
Yeah, and I would just mention, with ABA, we've actually been working with Adam and the Intrepid team on an M&A strategy at Hope Ridge, and Hope Ridge has grown all organically historically, and actually grew about 50% during COVID, despite the fact that we had to shut centers down for a couple months and then reopen in waves. And we have a great just organic unit economics engine at Hope Ridge. So we open de novo sites that are about 10,000 square feet. We can scale them, get to break even in about 6 or 7 months, and then ultimately drive each of those centers to about $4 million of revenue and pretty nice contribution margins. So I'd say the special sauce for Hope Wish has been that we have kind of intellectual property around opening those de novo sites, also moving into new states. We've done all that organically. So kind of going cross-border, building a cluster model where you get some economics of scale and you're able to leverage your clinician base across multiple centers. So we've always kind of prioritized organic over inorganic. During COVID, we did decide, and Shane touched on some of this, you just had a lot of smaller providers in an extremely fragmented space who all of a sudden were really struggling. And we expected multiples to be subdued. We expected to see what would have been a 10 times multiple for pretty small business to all of a sudden look like a single digits multiple. We didn't see as much of that. So I think we still continue to see pretty strong multiples despite some of the market headwinds that we experienced over the last year, even for smaller targets. And we thought there'd be kind of financial issues, solvency issues with some of these targets, and they'd be looking for liquidity and maybe more likely to seek out an exit. Haven't really seen it, so we just continue to be discerning around valuation and just compare the targets that we see to our organic unit economics, and if we could justify making an acquisition, especially to do things like I touched on earlier, just diversify the care setting, move into the home. Maybe invest in technology-oriented businesses that provide great virtual care tools or patient monitoring or patient engagement tools. We're looking at that. But we just continue to be circumspect about the M&A.
Yeah, I think it's funny, having worked in healthcare for about 10 years now, how it doesn't matter if you are a sub $1 million EBITDA company or a $100 million EBITDA company. Everybody in the healthcare sector deserves double-digit multiples on their M&A deal in their mind. And the idea of something like a global pandemic depressing those types of numbers is not even something that people would entertain. So I find it's an interesting space because there are so many investors like John and like the private equity that are backing Shane and the family office that are backing Rob, that are putting money in. And I think the providers have certainly gotten the sense that they are entitled to quite a lot of money in M&A transactions. Adam, I think maybe before we circle back into some more philosophical issues about value-based care, I would maybe want to touch a little bit on just because of the time, some of the differences between the types of investors that are out there, just given who we have on the panel. So, Shane, you started with Southwestern Eye before it became a private equity-backed business. It now is backed by HIG, which has a very good track record in healthcare. I'd like to just ask you about sort of the changes that you've seen in the way the business is run, the sophistication of the business, the focus on growth, and how are you positioned for success in the future with a partner like HIG?
Yeah. Well, it's interesting because ophthalmology is incredibly fragmented as well. I know we've talked about that a little bit with John's groups and Rob's as well. Ophthalmology is really not much different. It's, you look at businesses like derm and dental that kind of started to go down the road of kind of private equity investors, third-party sponsors, decades ago. Ophthalmology is just kind of starting on that process and began, in earnest, I would say, less than 10 years ago. And so what you find is you still find a lot of practices out there. I mean, I hate to use the phrase mom and pop, but it is really kind of the reality. Most of the ophthalmology practices in the country are, sub 10 doctor shops, mostly onesie twosie doctor shops that don't have a lot of corporate infrastructure, don't have a lot of sophistication in things like managed care negotiation on the contracts, marketing, sophisticated RCM departments, that sort of thing. And so I think what I was recognizing prior to our affiliation with HIG was that that's kind of where the world was headed. We had gotten to a point within our practice where we were starting to realize this kind of diseconomies of scale, right? Where we weren't small enough to be as nimble as we liked, but we weren't large enough to really have leverage with payers and vendors. And so we started to kind of preempt the private equity alignment by starting to supplement some of our infrastructure, bringing in kind of best in class, or at least the best that we could afford, kind of administrators to help us make sure that we were benefiting on the margin, whether it was on a payer contract or whether it was in kind of how we were negotiating equipment with a biomedical vendor. And so we started that process kind of early on. And then once we started to align with HIG and then later with other ophthalmology practices, that's only expanded. And so the partnership with HIG has allowed us to kind of move that needle more quickly, to bring on better talent, to focus on some of that back office a little bit more, so that when we partner with these other ophthalmology practices around the Southwest and beyond, we're able to talk about what we can do and how we can help supplement their operations. Certainly having a robust kind of medical executive committee that functions a little bit like a grand rounds, for instance, when the doctors get together in a hospital system, is beneficial also. But to be able to say, hey, listen, you haven't renegotiated this payer contract in 15 years. You're getting, 70% of Medicare. You should be getting 100%. And obviously that varies by state. But there's opportunities there for these providers on the margin, things that we're able to drive on now with more support, better sophistication from kind of this collaboration with the private equity sponsor and other practices. We're able to bring to bear some of these best practices with other groups that are lacking that support today. So I think that's been one of the biggest changes, is some of that back office kind of centralized support we're able to offer now that we haven't in the past, and is still unique in our space. But it also gives us the opportunity to be much more strategic in our M&A strategy, because as we've kind of been talking about, there's a lot of money in the market. And so what you're finding, regardless of whether it's behavioral health or whether it's ambulatory care or whether it's urgent care facilities, you have a lot of investors that I think are willing to overpay for assets, right? Because there's money in the market, there's money to spend. And in the past, we had to really just be opportunistic. If there was something that we could afford that we could jump on, then we'd do it. Whereas now we can be a little bit more strategic. If we need to overpay for an asset that aligns with our strategy, we're in a better position to do that than we would have been, prior to an alignment with a private equity investor like HIG. So it's calculated, right? We like Rob, want to focus on organic initiatives that don't cost us as much, but we can still pivot and work on the M&A stuff as well.
And that's really helpful, Shane. And Rob, I'm curious for your perspective. You recently raised capital from a family office, and maybe one of the questions we got from the audience here. And by the way, please do submit questions in the chat if you have them. In time permitting, we'll try to get to them. But Rob, what's been your experience working with a family office, and then maybe we can turn over to John for how you guys might do stuff the same or differently.
Yeah, I'm not sure it's that different. So, we have a really interesting bag. So we have on our investor group, we have a non-for-profit investor, we have a kind of a family office, and then we also have a private equity firm. So we have all three flavors kind of running around. I think what's probably most different about the family office to me is just that I think you have to really make sure that there's a fit there. I think probably private equity firms have a tendency to be a little bit more consistent in terms of the behaviors that you can expect. And I think a family office is probably more mercurial. It's probably a little more unique from one to the next to the next. And so I think making sure you have good alignment. And I think both good alignment in terms of just a good kind of strategic focus fit, and maybe even kind of a cultural fit between the two groups. But I think the other thing that can be a plus with it is that they also don't typically have, or at least my experience is they don't have like the external investor. And so they don't have that kind of fixed time horizon. They don't have maybe that same sort of time horizon pressure where they can sort of say, look, we can buy to own, or we can buy to sell, and we can do both, or we can do some hybrid between the two. And, you know, we don't have to worry so much about kind of the short term associated with it. But at the end of the day, you know, they're all finance guys. You maximize my investment, make sure there's a good sort of value proposition, et cetera. So I think it's probably just that there might be a little bit broader range of offices out there in terms of their culture. And so you just have to be thoughtful about that as you align yourself with one.
Mm-hmm. And John, I know you all have recently invested in a couple different healthcare services business in Florida, and I'd imagine, you know, it was a competitive process. How did you sort of differentiate Arsenal in that process to win, and relative to maybe some other options they might have had?
Yeah, I think as I mentioned earlier, our approach is a very thematic one, and we focus on company building. We take an operationally hands-on approach. So we're a firm that doesn't make a lot of platform investments. We spend 6 to 12 months building out investment themes. So we spent, over a year focused on value-based primary care, and ultimately made an investment last November into a business called Best Value that's based in Tampa in Florida. And, you know, we kind of build up a cadre of resources. So we work with lots of experts who are much smarter and deeper in areas of healthcare than finance guy like myself. But we'll kind of have, you know, population health expertise and social determinants and telehealth and virtual care and remote patient monitoring and kind of managed care, you know, Medicare Advantage expertise. So we try to engage with people who we think could be helpful. We put together kind of a blueprint for the market, and then we go out and look to engage with management teams. And the approach isn't for everybody. You know, some people are looking for management team sellers, more of a passive investor, which is not the approach that we take. If groups are, you know, amenable to maybe a more ambitious strategy, that's usually the right fit for us. So yeah, I think with Best Value, you just had a management team that was really interested in rolling equity and continuing to take advantage of a growing market. You know, I talked about ABA therapy. That's a very fragmented market with just a ton of white space. So there's so much more demand than supply. The de novo model really works. Primary care, you know, much like urgent care, and, you know, as you guys are familiar, it's a fragmented market, but there are centers kind of everywhere. So you have to take an M&A oriented approach. So we bring capital, but we also bring perspectives on, you know, and individuals, board members and executives who we think could really help with M&A, with business development, with payer contract negotiations. How can we grow and optimize our Medicare Advantage contracts? How can we think about, you know, ACO and the direct contracting model, which is now kind of superseding the next gen ACO, just to continue to take risk on our patient population, and then bring in the virtual care tools to enable us to, you know, manage patients more effectively, track providers more effectively. So we're investing into, you know, care management, population health, AI for patient screening, you know, different tools that we think will really help to improve the business and the quality of care. And so I think it's just kind of bringing those resources to bear that usually helps to set us apart.
You know, we haven't really had a lot of time to talk about value-based care, but I mean, looking at healthcare holistically and just the sort of the paradigm shift that has happened across the industry in terms of a shift from, you know, getting paid for what you order or what tests you order to getting paid to taking care of patients, right? There is an intersection between the ability to take better care of patients and the sort of expansion of technology and how it plays a role in healthcare. And obviously with COVID, I think there was an incredible push to normalize telehealth and to make digital and virtual care available. Much like I think Rob is probably looking at his average visits per day, maybe changing because COVID is, you know, hopefully let's all dissipating, right? We may see people kind of pull back from that telehealth type of operation and it might not be this sea change that everybody has thought about it, because there is something that people enjoy about going and actually having a physical interaction with the doctor. I'm curious, just as we close out though, when you look at the emergence of these technologies, and John mentioned AI, what each of you, I'd love to just hear, what do you think is sort of the next big thing that's going to take healthcare to the next level, that's really going to help America maybe put a dent in some of the difficulties that we've been having in controlling the cost of care while still improving the outcomes? We can just go around and start with Shane and maybe Rob and then John, just to close out with any thoughts there.
Yeah, that's a good question. I mean, certainly advances in technology are helpful. I mean, telehealth for us, I mean, we haven't found a really good niche for our practices yet. And maybe that has something to do with kind of the multi-specialty kind of nature of the care that we provide, and the emphasis on surgical care in particular. I mean, a lot of that just, it needs to be done in-house. For us, as it relates to technology, I think the benefit for the American people in the ophthalmology space, it aligns more closely with the drugs that are used and the technology that's done for the surgical procedures. So for the drugs, we're seeing more and more kind of implantable, kind of time-lapsed drugs that will be released over time, that then don't necessitate a patient using like eye drops multiple times a day, right? That is something that certainly adds to the type of quality care that they can receive, but also makes compliance with the doctor's orders that much easier, right? When they don't have to go get drops and remember to do that twice a day. So that's something we're seeing a lot of right now, and we're trying to do more to implement. Certainly the types of instruments that are used, kind of bladeless procedures, where you don't have to alter the shape of the eye. So a patient may get an implantable contact lens versus maybe a refractive procedure, where down the line that lens could be replaced with something else, right? So the types of how the procedures are done, how the outcomes are managed, preventing kind of infection rates from spiking. And I think a lot of these things, you do see some value-based care too in the types of retina drugs that are provided, less expensive alternatives, sometimes off-label. So those are the kinds of things that we're seeing, and I think we'll continue to see across the board, because again, there's such a large group of patients throughout the country that obviously need this type of care, that we need to find efficient ways to provide it, less expensive ways to provide it. But obviously, there's still a lot of cost that goes along with that.
Sure. Rob, your perspectives?
Yeah, so I think there's kind of two questions in there. I think related to virtual care, we saw an explosion of that early on with COVID, and it's always interesting. People said, "Oh, well, virtual care hasn't caught on," and I always laughed because I was like, "Well, it's because nobody's paid for it," and so it was sort of fighting through this lack of kind of financial support. So it's sort of obviously it's starting with very low cost, kind of super efficient models. That sort of changed with COVID. So we saw it absolutely explode. And I really wondered, gosh, do we still need bricks and mortar? Like, is this going to really is this what we've been waiting for, is the elbow in the curve, and it's going to totally transform? And we've seen that not really. It's actually sort of the more people have gotten comfortable coming back into the sites, the more we've seen the virtual care drop down. I think it's always going to be there for us. I think it's going to be, an option, and some people are going to like that option. But I don't know if it's going to be the next big wave, that people expect, or if it is, I think it might take a little longer to transition than people think. I think a lot of stuff in healthcare, people, when their elbow hurts, they want to show you that when I move it this way, I want you to feel it and it hurts. And, I want you to make sure you listen to my lungs, even though I'm complaining about an earache. And I still want you to say, and so I just think there's interesting kind of parts of the human condition that I think there's a quirks to that. So, I don't know. My perspective on it, or at least our experience to be on it, that it doesn't appear like it's made some massive transformation, at least for our sector of healthcare. In terms of the next big thing, so what is the next big thing? You know, my answer is probably gonna be a little bit boring in this, which is I think that healthcare has got so much opportunity to do the basic stuff well before you sort of get to doing the new kind of really interesting thing. You know, everything as basic as like, I think there's fair business trade practices. I think there should be fair business trade practices with the payers. I think there should be standardization of behaviors. And there's all sorts of kind of crazy things that are happening that promote so much inefficiency and cost in the system that rather than us trying to have the government manage down and create rule after rule after rule, to sort of create some foundational rules of engagement that we have in other lines of business and implement that would be incredible in terms of what that could do for healthcare. If you said, okay, but Rob, I need some technology. Come on, give me something, especially in your last minute. So I would say that for me, that what that probably would be is more about the patient platform and about kind of the interface, whether that ends up being an app or now it seems like apps are passe and it's moving more towards kind of mobile web, functionality. But I think stuff that creates a better engagement with the patient, a smoother continuity of care, and promotes stickiness with that patient. I think that's where you're going to see a lot of potential benefit. And those people can create a really high customer satisfaction combined with that. I think that creates a really material competitive advantage. So
I think maybe just along those lines, it would be good to just get rid of fax machines generally in healthcare and replace them with something else that might work a little bit better for OCR. Mike, I saw you just came on. I'm wondering if we can give John the last word or if we're out of time here.
No, of course. Please, John, go ahead.
Yeah, I won't take much time, but no, I think these guys raised good points. COVID's had a lot of pernicious effects, but I do think that tech adoption in healthcare has definitely been a silver lining. We've highlighted a lot of broken aspects of our system, and I think the pandemic served as a forcing function for things like digital engagement with patients, and because of rising consumerism, which to me means people are paying for more of their healthcare, therefore they're more engaged in their healthcare and increasingly comfortable with mobile technology. Virtual care, it's taking off, it's working, and I think certain subverticals and consumers have been willing participants in the traction that healthcare technology has experienced during the last year because outcomes have been positive and it's more cost effective, and so the government and payers have been supportive as well. And maybe just as Eitan alluded to, we do think that the growth in value-based care will further accelerate the same kind of long-term tech trends that I'm talking about. So this model of paying for outcomes rather than paying for volume, which is the cornerstone of our best value thesis that I mentioned, is really catching fire. It's a big contributor, I think, to the success of value-based care is the technology adoption. So you're seeing value-based oriented providers and payers doing really interesting things with AI, application of care management software to monitor physician performance and clinical analytics that we just really hadn't seen before. So we do anticipate a lot of interesting disruption and opportunity through virtual care.
Adam, Eitan, any final words yourself as moderators?
Look, we're at a really unique time here as we're coming out of COVID, and I think the world has changed a lot in the last 12 months here. I think, like John said, it's been a tough 12 months, but hopefully we're all coming out of here stronger with some new innovation here that's really going to transform healthcare and improve outcomes and make people feel better. So, really appreciate John, Rob, and Shane you joining, and Eitan, and Michael, thank you for hosting here.
Absolutely. Eitan, any final words?
No, thanks very much, everybody. Really appreciate all of your time and effort here.
Terrific. Well, thank you, everybody, on behalf of ACG Los Angeles. Thank you so much. Good night.
Thanks, everyone.
Thanks.
Bye.
Take care, guys.
Everybody.